the first time we held a hybrid session since the COVID start. We stopped having on-premise seminars since then. So today is the first time we're going to have such arrangement whereby we have a hybrid session, the on-premise and a webinar going concurrently. Today's topic is on mastering the US stock index futures. This is Eric here, your presenter for today. I'll be starting a webinar probably in another 1 to 2 minutes time, just to let people who are still signing in or coming in to get settled. So please give some time and just get comfortable. I'll come to you shortly. Hi, thank you for joining us on this seminar or webinar, Mastering the US Stock Index Futures. This is Eric here, the presenter for today. It's been 2 years since we last have our seminar held in our office at Raffles City Tower, level 7. So, so probably we will have more of such things whereby we're going to have a hybrid version. So some people who prefer to come and so that we can talk face-to-face can come down to our office. While some who prefer to do it online can do so via the webinar. If you have any questions, feel free to type into the chat box. If the questions is very relevant to what I'm talking at the moment, I will probably answer you. But if the questions I'm going to cover the topic in a few slides later, I'll probably hold on. Or if it's going to require a much longer reply, I'll probably leave it to the end of the seminar or webinar. Right, so we'll start. Okay, today's session, as I mentioned, Mastering US Stock Index Futures. My name is Eric Lee, Sales Director from Philip Nova. Just a quick disclaimer to show you that basically you'll see some charts, some example, some slides, some data, and do note that these are for educational purpose only. Okay, a little bit about myself. I joined Philip in 2004, so that's almost 18 years in this industry. I started off doing stocks and shares, and then later on I started to pick up futures and forex as a product, and then later on unit trusts as well. So I do find that there are some synergies in this kind of products as you start to gain more knowledge in one sector of them, one segment of them. You find that it actually helps you to become a better investor, better traders in all these products as well. So for today's presentation scope, just roughly going to cover 4 topics. The first one, we're going to start by giving you a quick introduction on US stock index futures, a quick introduction on how futures work. Then also, why should we be trading? Why should we be using futures as a product to trade as part of our portfolio management? And then how do we then manage, or how do we then analyze the stock index futures and decide when to do the trading, when to buy, when to sell, in particularly US stock index futures. But you'll find that what I share today is going to be pretty much useful to use in pretty much a concept is useful to use to invest in other assets class as well. Just that you may probably need to tweak a little bit on the types of data that we look at. And lastly, then I'm going to share a little bit about my services and how you can benefit from it. Okay, so very quickly, introduction to US stock index futures. So let's start by giving you a broad explanation on what futures trading is all about. So futures is basically a contract, it's an agreement between two parties to buy or to sell a commodity at a predetermined price for delivery in a futures date. Right. So what this essentially meant is that, you know, when futures product is first created, it's actually created for farmers, for commodities traders. You know, farmers need to sell their products like wheat, sugar, or it could be like cattle and such. So then the buyers, it could be a companies or some businesses. They will then need to come up with to lock into the price in the futures. So they do that by standardizing a contract so that this contract can be passed along to various parties, can be traded in the market. So then, of course, right now, people don't know, there are still products on commodities itself, but the major bulk of the trading activities for futures is actually focused on stock index futures or financial assets. Okay, give me a moment. On some technical issue, just going to do some settings. Okay, people on my webinar, not seeing my slides. Yeah. Okay, so then, so as I mentioned, in the past, when they first started using futures as a product to trade, the main purpose is meant for hedging against price fluctuations, and probably like the businesses, they need to, because futures, the price moves day in, day out, so they need to be able to lock into a certain price for accounting purposes. So they use that as a hedging tool. So the producer of the commodities, like farmers, they will then want to be able to lock into a certain price and sell the futures product. Whereas the companies who buy those commodities may want to use the futures market to buy the futures contract to lock in at a certain price before they actually receive the goods. So that's what futures is meant for. But nowadays, as I mentioned, it's mostly for speculation, for price appreciation, not so much of hedging. Hedging is still around, but primarily they are the commercials, they are the companies, businesses that are using that for hedging purpose. People nowadays, most of the volume focus are actually from traders who are participating in the speculation. If you think that the price will go up, you just buy. If you think the price will go down, you just sell first. Right. So in the past, as Insert has shown, trading on futures is done on open outcry system. But this is, I think, more or less gone. Probably some countries or some exchange may still retain a part of it. Like in Singapore, we no longer have that. Most people are trading through electronically, like via PC or via a mobile app. So what is a stock index? Stock index essentially is just a combination, a mathematical formula for compiling all the stocks, right, into a basket, and then to tabulate out a number, which is the index number. So as all these stocks starts to goes up, right, then the formula will calculate the actual index, the impact that you will have on the index itself. Ultimately, you'll turn out a number which shows the index going up. So this example here I'm showing is is on the Dow Jones Index. So Dow Jones Index, there are 30 US blue chip companies in it. So yeah, so in US, apart from Dow Jones, you have the S&P 500, you have the Russell 2000, and then you have the Nasdaq as well. Yeah, but most people will be more familiar with Dow Jones Index, especially those in those more in the older generation, because it's more easily to understand. There are only 30 stocks in it. Whereas for S&P 500 and Nasdaq, probably not. Some people may not be as familiar with them. But of course, younger generations who likes to trade tech growth stocks, they'll be very familiar with what Nasdaq is, right? So why should I then trade the US stock index futures, right? So since it's a basket of stocks, why not I just go and buy the stocks instead? Why should I then choose the US stock index for trading, right? I think the first obvious reason is that you're able to participate, you're able to trade in the bull or bear market, right, for futures. Because for stocks, you can also do short selling. If, for example, in the beginning of the year, you foresee that inflation is going to be a big problem, you may want to sell the stocks, and if you have done so, of course, you have profited from it, right? But so those are the macro movement. Or for some reason, after analyzing a company, you think that the business is going to go downhill, you may want to do short sell the stock and then buy back when it goes down to a price that is a value that is what the stock should be valued at, right? So then that's a bull and bear, short buying and short selling. But short selling for stocks is much more complicated. Firstly, not all account types allow you to do so, and not all stocks you are able to do the short selling at, because by exchange rule, you will need to be able to borrow the script, borrow the shares before you can short sell. You need to pay interest for it, and halfway through while you're short selling it, perhaps even though your view is correct, but the person who you borrow the share from decide to sell the shares, right? If that were to happen and you are not able to, or the broker who is assisting you, not able to find new shares to borrow, you will then need to stop your short selling, right, to cover it back so that you can return the scripts. So that is much more complicated. And that is the reason why futures in that sense is easier, because firstly, if it's a broad market view that you think that the macro economy wise it's not going to be good, you need not trouble yourself by looking out for individual stocks to buy or to sell. You can simply participate in one action by trading the US stock index futures. So again, participate in global market. You have stock index not just for the US market. You have the stock index for China, for Japan, for Singapore as well. So sitting here in Singapore, if you have some view on the Japanese market, you have a certain view on the Chinese market, you can participate your view and put it into action by trading a single instrument, which is the stock index futures, right? And you need not then need not to go search out for individual stocks to do the trading in. And of course, low transaction costs. And I say that in comparison to traditional products like stocks and bonds, futures generally has a much more lower transaction cost. Not just in the transaction cost itself, as I mentioned, if you want to short sell on stocks, you will need to pay interest for it. Whereas if you were to short sell on the futures itself, there's no financing cost, right? There's only one charge, which is the commission charge. no further charge for that. Whereas for short selling of stocks, there are more costs involved and more complicated process. Okay, so these are examples of some of the US stock index that is available for trading. You have the Dow Jones, the S&P, the Nasdaq, and the Russell. The examples I show here are the micro contract. So the first column here, the first column after the contract name is initial margin. Initial margin is basically the amount that you need to have in your account in order for you to initiate a new position, to start a new position, right? So I show you the first column in USD and the second, it's the second column in USD and the third column in the Sing equivalent for your reference. Then the next you have the contract size, the tick value, and you have the average daily range. Average daily range I take from the past 1 year. The market is basically much more volatile this year. So the average daily range has increased by quite a fair bit as compared to maybe 2 or 3 years back. Okay, I'm just going to run through some quick examples of how you calculate the futures P&L. So firstly, understanding a contract value is basically, I'm going to use the Dow Jones as an example. So you use per index point is 50 cents. You multiply by the index traded. So for example, if Dow Jones is trading at 30,000 points, you use 30,000 points times US 50 cents and you get US $15,000. So essentially, if this is a stock that you want to buy and you want to pay up for, you actually need to come up with $15,000. But because this is a futures contract, you need not come up with $15,000 to be able to initiate a position on this. So as mentioned in the initial margin, which is $825 US. So that is approximately about 18 times leverage and about 5.5% of the contract value required for to start a new position on the micro Dow Jones Index. Okay, then how do you calculate P&L? Similarly, 1 point is equal to 50 cents. So for example, if you were to buy Dow Jones at 30,000 and then you subsequently sell at 30,100, or you sell at 29,900. So the first example is a gain, the second example is a loss. So in the first example, you use 30,100 minus 30,000 multiplied by US 50 cents. So your profit is $50 per contract, US $50 per contract. So that's on the basis of a 100-point gain. So on a 100-point loss, it's the same way. So it just ended up with a loss of US $50. Okay, so of course there are a few more things that we need to be take note of before you actually do trade futures itself. So if you are very interested in it, you can talk to me after the webinar. I'll be glad to, after the seminar, I'll be glad to share with you more. But for now, I want to go on to cover a more interesting part of the topic of today's seminar, which is how you go about analyzing the US stock index futures. Right? I go about this through a top-down approach. You know, starting off with understanding how the economy is, and then understanding how the financial state of the stock market is, and then you go on to the market strength, when the market moves, what is it telling us about the strength of the market. Then we go on to look at the chart itself to then try to find the right time to go in to buy, or find the right time to go in to sell. Right? I think this is the best way, because in this way, if you think about your investment or your trading this way, you will not just be swayed by the market movement, because many a times, if you just purely look at the price chart, the price movement, sometimes you won't understand why it goes up, why it comes down, right? And good news, it could go down. Bad news, it could go up, right? But if you study right from the top, you understand the underlying conditions the market is in, what is the main theme driving the market movement, then whatever the market move will start to make more sense to you, and you won't be scared off, right, by cut your position prematurely by the market movement. Okay, so first off, we start with macroeconomic analysis. Okay, of course there are a lot more data, lots more economic data that we can look at. So for every topic I'm touching on, every segment I'm touching on, I'm just going to share two with you that you can take back and study on them. The first one is new single-family housing units started, right? So in the US, they have various government agencies that they will every month they will churn out reports. You know, they will announce this is how the economy is. So for these new single-family housing units, I think it's a monthly data, right? So it tells you how many these houses, single-family houses, are being sold. But if you think about it, if you study about this, you know that actually this new single-family housing only takes up about 10% of the sale of all the real estates done, housing sale done in the United States. But somehow this particular data, this particular indicator, had a very close relationship in how the economy actually performed, and also on how the stock market is being influenced by it, right? So you will see on this price chart here, on the top here, I show the S&P 500. And at the bottom is the new single-family housing unit started, right? So on the price chart, I hope you can see this. On the price chart itself, on top, where we have the S&P 500 chart, you have some great portion here, great portion that is being highlighted out. So those are the recession period, right? So immediately you can see that the arrows I've drawn that pointed out to you, right? When you have the this economic data on the new single-family housing unit started that is going down, while the market, even though the S&P 500 is going up, and possibly at that point in time, the economy is also strong because there's no recession, but you will find that this economic indicator will actually start to lead the market in a sense by approximately 1 to 2 years. So you will start to peak, you will start to come down about 1 to 2 years before the economy start to tank, and also before the S&P 500 start to drop, right? So it can give us a forewarning, right? 1 to 2 years ahead of time that things are not looking as rosy. It doesn't mean that we go and sell immediately. It just means that, oh, okay, we take note of this, you know, put it aside, because like I said, this is a monthly data. You need not look at it every day, right? Just once a month or even once every 3 months. As long as you are not seeing it peaking, you need not even look at it once a month. But once you see peaking, maybe once every 3 months, and after 1 year or 1.5 years later, you then may want to start watching out and start to look out for other indicators to get a more idea of how the economy is. Because 1 to 2 years later, it's very likely that things will not look as rosy, and they may actually start coming down. So the recent example here at the very right-hand side of the chart, this particular economic indicator peaks in, I think it was in August 2021. Sorry, yeah, I think May 2021. About 1 year, May 2020, about 1.5 years before the S&P 500 peaks in January 2022. So, and if you look back, back in 2009, back in the tech bubble crisis, it peaks as well way before the stock market actually start turning down. Okay, so another indicator you can look up for, this one is being reported by the Federal Reserve. I have the link here on the website that you can go and check it out. It's called the US Recession Probabilities. So how they calculate this is that they have a model that applied 4 monthly variables. The variables I've stated there: non-farm payroll, index of industrial production, real personal income, and then you have the real manufacturing and trades. So they have mathematical formula to calculate that, to calculate the probability. I do not know exactly how they do the calculation, but you can see that it pretty much points out exactly when the recession is going to happen since 1970s until now, right? So how do we use this indicator, right? Is being I think it's also a monthly announced data. So how you use it is that if you see that this indicator pops up above 10, right, it moves from 0 to 100, right? 100 meaning that 100% there's a chance for recession. 0 means that 0% chance there's a recession. So basically, when it pops up above 10%, then you should watch it. We should watch out, because very likelihood recession is here, and once recession is here, then it's going to impact the stock market tremendously. So the last 2 examples that we see, that we have this indicator that pops up above 10% is back in the 2000 tech bubble crisis, as well as the 2009 great financial crisis. So I plot out for you on the dotted vertical line. Is at the point in time whereby this indicator pops above 10%. So as a trader, as an investor, if you are able to catch this beforehand, you are able to avoid some pain by selling, either reducing your investment portfolio position, hold more cash, or hold more bonds than stocks, and you may save yourself some heartache. And when the S&P 500, the stock index actually do come back down, you'll be able to buy back at better prices, right? So also back in 2020, because of the COVID-19 incident, this indicator did pop up, but it's a very swift recession. Like the recession just started and ended within 2 months. So basically, the indicator is not much help then, and also because of the situation of the crisis, it just happened too suddenly. The market is actually doing well at that point in time. A lot of economic indicator was actually pretty good. So there probably won't be a recession if not for the lockdown due to the COVID-19 pandemic. Okay, so this indicator and the new housing index is beyond that. Of course, there are lots more, but for today, let's move on. The top-down approach, we start with economic, then we move on to the financial analysis. And financial analysis, how do we study the financial state of the stock market? Okay, so one of the very commonly used indicator people like to use to value a stock is a P ratio, price to earnings ratio. So for my clients who talk to me or who have been receiving frequent updates from me, they will know what this is and how I like to use this to sort of find an opportune time to go in to invest in a stock, right? But apart from using price to earnings ratio on the stock, you can also use that on the stock index itself, right? Of course, it's not as commonly available, but they do our website. If you Google, let's say S&P 500 price to earnings ratio, you'll probably be able to find a couple of sites that offers this data to you, right? What I've shown here is from Bloomberg. showing you at the bottom the price earning ratio in blue, and on top is the price chart of the S&P 500, right? So one notable things to note is that you can see over the past 30 years, 1990 until now, about 30 years, yep. This price to P ratio of the S&P moved within a range of 25 times to 17 times, right? Of course, there are period of time that it blew way past 25. There are period of time where it fall way below 17 times. But if an investor with a mid to long term outlook were to invest in the index or to buy the index when it's close to 17 times PE, he will likely do well, right? Over the next 3 to 5 years, right? Of course, if he's a longer term investor, all the more better for him, right? So knowing this, you will know that if you want to invest or trade an index with a medium to long term outlook, you don't try to buy it when it's at 23 or 24 times PE. Are there chances when you buy at 23, 24 times and you'll go way higher? Yes, there is, right? We've seen that recently, right? Because of the Federal Reserve money printing policy, right? The last 2 years prior to this year, the stock market is actually pretty good, right? And so during the dot-com era, it also went way past 25 times, right? But beyond these 2 points in time, if you were to buy at 23 or 24 times PE, or even at 25 PE, right? At any other point in time, you'll find that it's pretty difficult for you to for your profit, to go up much higher, right? Primarily because the valuation is too rich, too high, right? But now, now the PE ratio of the S&P 500 is at 18 times, right? So it's not 17 times yet, but it's pretty close, right? If you were to buy here, of course, if the Federal Reserve continue to increase interest rate aggressively, then very likelihood the index may go down, right? But if you have the outlook that's a mid to long term, then buying at this level is pretty good, right? At 18 times, right? PE. Then another indicator, not exactly a financial indicator, but it does have some valuation you can use it to value the stock market index itself, right? It's called family is called the Buffett indicator, right? I think it was in during the great financial crisis that I first heard of this indicator from Warren Buffett interview, right? At that time, everything was very gloomy. This indicator he used is a U.S. stock market cap per GDP index. So basically, you use the market cap of all the stocks listed in the U.S. market, add them all up together, and then you divide by the U.S. GDP, the gross domestic product, and you will come up with an index. At that point in time, this is over here in somewhere in 2009, that this index went way below, went to 0.8 or 0.7 times, right? So then I think Buffett start to share about this, and then he says one of the indicators you look at to find a point to think that, and he thinks that the market is attractive at the moment, right? But of course, at that point in time, it's all bad news, right? Everybody is thinking about 1929 all over again, Great Depression all over again. nobody is buying stocks, right? But of course, at that point in time, if you were to buy, your portfolio will be doing very well. So, one thing about this indicator I find is that if you are using this indicator on the premise that it will fall within like P ratio, it falls within mentioned just now, P ratio is 17 times to 25 times, and then you think that this particular index should fall within 0.7 to 1.4, and I don't think it works this way, because firstly, the number of stocks listed in the US market is always growing, right? Because this indicator, you need to add up all the market cap, right? So eventually you are going to have more and more stocks, right, in the universe, in the calculations. So by default of the calculation, this index itself will tend to gyrate more to the upside, meaning that if you look at it in blocks of 10 years and 10 years at a time, you'll find that it will generally be outward sloping, right? If you think that you're going to come back to 0.4 times, like back in the 70s, I don't think you'll do that, right? So to do this, to use this indicator well, I feel that we need to normalize the data. So at the bottom, I have my Buffett cycle index, basically using the index, the Buffett indicator itself, and normalize it to a range of 0 to 100. Right, and then I'm comparing the performance of this index against its historical performance, right? So you move within a range if you normalize it, right? And that's where we are able to pick up buy points, even though the index itself or the indicator itself may be pointing a little bit high, but when you look at a cycle index, you'll find that it's attractive valuation level. So at the bottom indicator, excuse me, at my Buffett cycle index, I point out in arrows periods of time whereby it falls to the buy zone. So back in 2000 and 2003, 2009, and currently, because of the market sell down over the past 9 months, it hasn't reached the buy zone yet, but it's pretty close, right? So perhaps if the market stay around here, or it may even go down lower, the next couple of months, we may see this indicator or this index fall to the buy zone, and then there will be an alert to us that to take a close look at this index, at this S&P 500 potential buy opportunity, right? So by looking at the financial analysis, firstly, we have the P ratio 18 times, pretty close to 17 times, the lower boundary of the range. And we have the Buffett cycle index, which is pretty close to the buy zone itself. Next, we look at the market strength analysis. Okay, the difference between market strength and the financial is that the financial analysis, you look at valuation. Market strength, you then look at the participants, right? People like you and I. You know, when we trade, when we invest, when we buy, we push the stock up, we push the stocks down. So these actions will then be able to help us to measure the strength of the bull or the strength of the bear, right? So one such indicator is this indicator called advanced decline line, right? Advanced decline line is cumulative. Basically, every day itself, you take the number of stocks that is moving up, advancing, and you minus off the number of stocks that is falling down, that's coming down, and you get a number. So if today you have more stocks going up than stocks coming down, let's say you have 300 stocks going up, you have 200 stocks going down. So today you will have a plus 100 to the advanced decline line. If today you have 300 stocks coming down and 200 stocks going up, then today you will have a minus 100 to the advanced decline line, right? And this number is cumulative. You add on to the prior number to form a continuous line, and this line is what we call the advanced decline line. It basically measure the strength of the market, right? Because if you have stock indices that is going up, but you have an advanced decline line that is not going up in tandem, right? Not going up together, or is coming down, then it shows that this index that goes up lacks strength or lacks conviction. So one such example is shown here in the later part of 2021, right? So basically, this bull market peaks in maybe 2nd or 3rd of January 2022. But if you compare these together, or you put it side by side with advanced decline line, you'll see that advanced decline line actually forms a lower peak than the S&P 500. So then this gives us the first indication that it is lacking strength, right? The up move, the bull is lacking strength for S&P 500, right? In recent example, in June 2022, right? These are just 3 months or 4 months back, right? The S&P bottoms, and then within like 1 to 1.5 months time, right? It shoot right from 3,600 to about close to 4,300, right? And so what happened in June 2022? You have the S&P 500 that is making new lows, but the advanced decline line fails to make new low, right? So it gives you a signal that the fall, the drop in the share price itself lacks conviction, right? It lacks conviction. So thereby, when the market turns, a trader can then participate in the bull run by then buying the S&P 500. Of course, right now, ever since the bull run, the short 1 to 1.5 months of up move, the S&P 500 has again fallen and broke June low. So as of now, we see that the advanced decline line, when you compare the low in June and the low now, even though the S&P 500 had broken the low in June, but the advanced decline line has not broken the low in June, right? So it is nothing definitive yet, but you just, I mean, for me as a trader, just telling me to pay attention, right? If the market turns from here, then very likelihood that the momentum may pick up for an up move, right? Because advanced decline line is not agreeing with the S&P 500 at this moment. But of course, if over the next 2 weeks or so, S&P 500 continue falling down, then I'm pretty sure that advanced decline line will continue to fall, and then it will drop June, right? If that were to happen, then it just meant that, oh, well, it agrees, finally agrees, and we move on. We wait for the next signal based on this advanced decline line, right? The next index I use is a FANG Plus PV index. Well, this is an index that I actually created myself using FANG Plus. If you are, I don't know if you're aware, FANG Plus is basically FANG started off as an acronym to for people to refer to the high growth mega cap stocks like Facebook, Apple, Amazon, Netflix, and G is for Google. Then of course, now the FANG Plus itself, I think was the ICE Intercontinental Exchange created an index called a FANG Plus index. It composed of 10 mega cap growth stocks. So so this index itself basically measure the movement of these 10 mega cap growth stock. And just to point to you, why is this index significant? Because if you go and Google this term mega cap 8, right, it basically refers to 8 US mega cap companies, right, that are inside the FANG Plus itself. FANG Plus has another 2 more, which is the two China company, Alibaba and Baidu. But both these companies, they actually their value has dropped quite tremendously over the past 2 years. Even way before the US sell down, they have already started falling. So I mean the weightage to this index is actually pretty small. So basically, FANG Plus is almost the same as mega cap 8, right? So mega cap 8 is their market cap is 50% of S&P 500 growth index. S&P 500 growth index are basically composed of growth, or mostly they are technology, but it may not necessarily be technology. They are basically just stocks with a high growth, right? So, and this 8 stock itself influence 50% of the market movement of this entire S&P 500 growth index. So 8 stocks, 50%, the other 492 stocks takes up the other 50%. So you can see how significant this 8 stock, this FANG Plus stock is to the stock market. When they move, they are basically moving the market along. So the way I see it is that this market strength, I think of FANG Plus as like generals. You know, when you go for battle, you have the generals and then you have the foot soldiers. So the ADL basically are all the stocks entirely, right? They are like the foot soldiers. The FANG Plus, they are like the generals, right? So to win a battle, the generals must move, the soldiers must move as well, right? So you cannot have the generals move and the soldiers sitting back. No matter how good strategies the generals are, they can't win the battle just by the aid of them, right? But if you have just the soldiers that go ahead while the generals are sitting back, you can win the battle as well, right? You cannot have just winning by might. You need strategy as well. So both these, if they agree together, then that is a very strong signal to follow, right? So when I use this FANG Plus index itself, it's pretty much the same way that I use it on the ADL as well, right? It must agree, right? The movement must agree with the S&P 500. Whenever the movement does not agree, then I think that is a alert to me that the market may not be moving in the right direction, right? So let me give you an example. For example, back in this when is this? First quarter of this year, back in March, when we have the initial sell down, and then subsequently the S&P index actually jumps up and pretty closely hit the January high, right? So when you look at the price chart itself, it actually broke the high that it went up to in February, which if you were just purely looking at the price chart itself, is a good signal, right? It's a bullish signal, right? Because price action, it shows that it has broken the downtrend, right, by breaking the previous resistance point, right? But if you reference it down to the ADL, and also at that point, reference it down to the FANG Plus PV index, you'll find that the PV index is actually going lower, right? So then this shows that this advance in S&P 500 it lacks strength, right? Probably some fake move, right? So you find a point to go short, right, when it finally turns, right? Because it must agree with the FANG Plus index, it must agree with the ADL, right? So similarly, back in June itself, just now I showed you the example of the ADL failing to go lower, even though the S&P 500 broke new low. So back in June, not only did the ADL did not agree with the S&P 500. The FANG Plus index did not agree as well. The FANG Plus index actually goes higher and form a higher low, right? So, and because of that, then the downtrend lacks conviction. So when the market turns, and only at that point in time, then you start looking at the price chart. Then you start using whatever indicators, technical indicators that you are using to look for a buy signal, right? Because you have all these conditions, the economy, the financial analysis, and plus the market strength index, right? In fact, I look at this line of analysis this way. If I intend to have my position to be a mid to long term kind of position, I'll pay more attention to the macroeconomic analysis. I'll pay more attention to the financial valuation analysis, right? Because it's for mid to long term. But if my position I intend to be more short term in nature, then I'll pay more attention to the ADR, I'll pay more attention to the FANG Plus index, because these are actual money involved, right? In order for this index to move, there are traders out there who are placing their bet, buying up the stock or selling down the stock. And the reason, and when they do that, it causes the index to move. Similar to this FANG index as well. There are money involved buying the FANG stock, the 10 FANG stock, or selling the 10 FANG stock. That then in turn created this index, this indicator to move accordingly, right? So understanding them will then help us to be a better trader in the short term, right? So for now, just like I mentioned, current situation for ADL is that it's a little bit unclear. We see that S&P 500 has fallen to new low below June, but the ADL did not break, but it's pretty close, but did not break June low. So FANG Plus PV index is more bullish, right? It's way higher than the June low itself, firstly, and then basically, even though the S&P 500 has broken new low, the FANG Plus PV index has not broken new low yet, and it's still quite far away from it. So how I'm going to use it later, I will have a summarized view of all these indicators that I'm using on a long-term valuation method using the macroeconomic and financial analysis, and also another chart whereby I combine the ADL and PV. These are FANG Plus PV index, so that you can have a better grasp of how the condition is right now. Okay, so lastly, right, after you've done all those analysis, then you move on to look at a trend. Then you move on to look at the chart. So for the chart itself, I mentioned that I've been in this industry for 18 years, and I've used a lot of indicators. I've attended a lot of courses, I've read a lot of technical trading books, and I've tried a lot of indicators. And I can tell you this is that the best is still the price chart itself. Like all the other fanciful indicators I use, stochastic, RSI, MACD, and now there are hundreds of them, right? They are all mathematical formula derived from the price chart, right? The price chart is the raw data. Open, high, low, close, plus the volume is the raw data. And they are the one that tells you the most useful information. Because if traders as a group were to buy, right, we as a group will push up the price such that you'll break certain resistance levels, such that you'll form certain formation, right? So it's not always, those indicators are delayed, right? They need to gather all this data before they can calculate and they start to draw certain or certain trend or certain signals, right? So, but the price itself is real time, right? Whatever people are doing right now, using their real money to buy out or to sell down, right? So therefore, for now, I usually I also advise you just look at the price chart itself. Try to use the price action to give you a signal when to buy and when to sell. Of course, you can support it with some indicators, but don't just purely rely on indicators. And as I mentioned, even before you go on to chart and use the price action, do all those analysis that I mentioned beforehand, right? Understand what's the condition market is in. Is it high valuation now? Is it low valuation now? And what's the macroeconomic condition like? Are we entering the recession or not entering the recession, right? Because that will then impact how the stock market or how the stock index move, right? So in this technical analysis, there's this theory that I pretty much loosely, basically, there are some materials or some books written on it, but frankly, don't use complicated stuff, right? So I pick out these three rules that I use for understanding price action. Firstly, is that market is in an uptrend if the price advances above previous important high. Secondly, market discount all news, meaning that whatever you are reading out there, probably 100 of us, 60 of us are buyers, 40 of us are sellers. Then we will put in our money, and at the end of the day, whatever our action is will cause the price to move up or move down, right? So based on, because we absorb the news and then we put it into action by buying and selling in the market. Then lastly, trends exist until a definite stimulus proof that they have ended. Just very quickly show you what these 3 points meant. Is that if the market is in the downtrend, you have the price that is falling, making new low, lower than previous low. And then when it rebounds up and forms a new high, the high is also lower than previous high. So then this is a downtrend. So how the market switch from a downtrend to uptrend is that firstly, it stopped to fall lower, it stopped making new low. And then secondly, it turns up and breaks the previous high, right? So then it turns from a downtrend to uptrend. So from then onwards, it then moves up and forming higher high, higher low, higher high, higher low, right? So so by Dow theory is that if it's forming higher higher low, you keep on assuming that it's an uptrend, right? The reason why we need to assume is that, of course, the trend will come to an end, but as a trader, you cannot second guess too much, right? If you have done your work, you analyze the condition of the market, you have decided based on analysis, this is the direction the market is going to take, and the price action agrees with you, you just have to take your put your trade into action, right? And have to assume that this price action will continue to move in the direction. Let's say you buy, will continue to go higher up. Well, of course, eventually will come to a point that it may stop going up, and if you enter only right before then when the trend turns and it shows that it's no longer agreeing with you, and then you start to look at the market strength, ADL, and then FANG Plus, it's also showing the same thing, it's turning down, then you want to get out and cut loss, right? But if the price action did a move that is contrary, you buy, it comes down, it breaks new low, but then you look at the FANG Plus, you look at the ADL, no, the ADL and the FANG Plus are going higher. Yeah, of course, at those point in time, as a trader, you have to make certain judgment call, right? If you think the analysis is correct, and ADL, FANG Plus agrees with you, then sometimes you may want to ignore the price action, because you do see that whatever I'm showing you here, the price turns from downtrend to uptrend is a perfect example, right? But actual market is not so perfect, right? You won't see a nicely, sometimes you'll see nicely falling downtrend, but there are sometimes you won't see those kind of nice falling downtrend. Sometimes it may just go up, break new high, and then come back, continue and break new low again. So that may happen, right? So so again, when it's going up from new high and higher high, higher low, so you will know that the uptrend has stopped when the price stops making new high, and when it turns down and break the previous low. So then the market, the index itself, has turned from an uptrend to a downtrend. So essentially, how a trader you should be doing is that when you have done your analysis, let's say back in January, the Buffett indicator is way high, the P ratio is also way high, and then you look at the market strength. I've shown you then, right? The ADL did not agree with the market top. When the market tops in January 2022, ADL did not form a new high. So when you have higher valuation and all those indicators that is pointing you that is market is very pricey, then you have ADL, the market strength, that is telling you that the market strength lack conviction. Then when you start to look at the price chart itself and you see this price action break down, so only then you go and do the short selling on the index itself, right? That you'll find more success, right? Trading this way, right? So putting them all together, right? So just now I mentioned to you the market condition. So you have the first slide. You see, I've included the new single-family housing units. I've included the recession probability index. I've included the buffer cycle index. Sad to say, I can't include the P ratio because this particular software I'm using don't have the P ratio for S&P 500, so I'm not able to include it in to show you. But you can look at it from the website. For me, I use Bloomberg as a source for the S&P P ratio. You can reference it, even though you cannot jumble them up into a single chart, right? But there is this other indicator here I showed, I put out and I put question marks. Okay, but this is an indicator that I will later, towards the end, when I share about my service, this is one of the indicators that I will be reviewing for those who are engaged me, open account with me. I'll share more about what this indicator is and how you can also use it together with the rest to understand the market condition. So basically, for this indicator, it is a buy-only indicator, meaning that it is good for picking up a buy signal, not so good in picking up sell signal. And this indicator, whenever it falls below 20, you'll find that it's a good buy point. When it falls below 20, it's a good buy point. It's a good buy point. It's a good buy point for the S&P 500, right? So doesn't happen often. Like say 2009 until now. This is the fifth time, right? Of course, right now we are the fifth time whereby it falls below 20, right? Doesn't mean you fall below 20 immediately buy. As I mentioned, step by step, right? You start with market condition, then you move on to the trading condition. What is the market strength like? So for that, just like I've shared about Fan Plus, I've shared about the advanced decline line, and there are also others that you can use apart from these, which I share with my clients for those who open account with me. So so for now the condition, okay, I'm talking right now the condition for the we look at the long-term macroeconomic condition. Housing, single-family housing units has fallen, right? No definitive signal as of yet. I mean, it does give us a signal back in January that the market may be weakening. So as of now, there's no signal, right? Because these first two indicators is basically good for picking up market top, right? Recession probabilities, in fact, it hasn't goes up yet. Yeah, you may wonder why, because this high inflation, the Fed increasing interest rates so aggressively, and yet the recession probability is still below 10, right? And the reason is because the job market is very strong, right? In the US, the job market is still very strong. There's this indicator that the Federal Reserve used to measure the job market, which is the number of job openings divided by the number of unemployed workers, right? So right now, this index that they use is at 1.4. It was at the peak 1 year ago. It was at 2, right? So meaning there are two times the number of job openings as compared to the number of unemployed people out there looking for jobs. And now it's at 1.4, right? It's still pretty high. Basically, it meant that whoever want to look for a job right now, right? I'm not talking about you picking the best job for you. I'm just talking about you just want to find any job to do. there are basically more jobs out there, right, than the number of unemployed people by a factor of 1.4. So, so that's why the job market is so strong, right? That's why the wages are still remaining sticky, and that is the reason why even though with the interest rate being increased so aggressively, the recession probability still haven't popped up, right, to above 10%, right? So perhaps when the number of job openings has go way above the number of unemployed, then you may start to see this recession probability index start going up, right? So as of now, despite all this interest rate increase, the job market is still fairly strong in the US. So the economy is still, in a sense, still no recession yet, right? So then you have the Buffett cycle and this index and the P ratio you can use to pick up the buy point. So Buffett, as I mentioned, Buffett cycle index hasn't reached the buy zone yet, pretty close. This indicator has reached the buy zone. So the trading condition right now, the FANG Plus index, I'm waiting for it to break this August high. So the moment it breaks August high, right, even if the S&P 500 hasn't gone above this August high, I think it's a good indicator, right? Because generally, FANG Plus, the generals usually lead first, right, before the soldiers follow. And then, of course, we have the ADL. That, nothing much here, but the last 2-3 days of movement, it has uptick slightly. Hopefully, right, if the market continues to be strong over, let's say in October, you may have the ADL going higher, then we may have some stronger indication, right? And historically, last quarter, usually the strongest for the US market, because coming to year end, Christmas season, people are usually more happy, joyful, better mood. So, and also, all those buying gifts and all those Thanksgiving, Black Friday sale, it sort of will spur up businesses, right? So, so if and we have been down for the past 9 months, so there's a pretty good chance that the stock market may go up slightly, right, the last quarter. Now, of course, we do not fight the Fed. The Fed says that they're going to increase the interest rate very aggressively. So I would say watch out for next Wednesday inflation data. Because last month's inflation data was down slightly, but the core inflation was a little bit sticky. So so we shall see next Wednesday how the inflation data comes out. If the inflation data comes out to be much lower, perhaps the Fed may be more dovish and will not be so headstrong in their stance. Then we may have a more better mood for the stock market itself. Okay, let me see some questions. Okay, there's a question asking about the commission rate for the trading of US stock indices. Yeah, just now I have a slide for it. I think I went past it and forgot to mention. If you were to trade the micro E-mini indexes itself, is US 98 cents per contract. So yeah, okay, so it's almost $1, US $1 per contract per trade. Okay, is my coaching session chargeable? No, it's not chargeable. Is demo account free? Yes, demo account is free. What is the amount to open account? Opening an account is just filling out the form. You do not need to fund in to open an account, right? But I do have some promotion later I'm going to share, and the promotion has some funding condition. So I'm going to share a little bit more after this, right? So that's the situation now for the trading condition and for the market, right? So yeah, I'm going to move on here to how you benefit from opening an account with me. Firstly, this is the services I provide for my clients. All of them are free of charge. So email, the more in-depth research on various asset classes, sectors, and stocks. So of course, it depends on the type of account you open. If you open a stock trading account, and you'll be receiving more on the stocks-related news. If you open a Forex trading account, you'll be receiving Forex news. If you're opening up a futures trading account, you'll then be receiving these futures-related news and trading ideas. So, but I'm more active in my WhatsApp because email is just probably the mode. If I want to write a more in-depth topic, more words involved, I will prefer it on email rather than on the WhatsApp. Right. So on WhatsApp, I have the daily market update. So this is just basically telling you what happened the day before. Singapore stocks trading opportunities, overseas stocks trading opportunities for those who open stocks trading account. Singapore stocks earnings announcement schedule also for those who open a stock trading account. Then futures trading opportunities are those, let's say after today you're interested to open a futures trading account to trade this S&P stock index futures. You can sign this up, and I'll be sending you whenever I see some trading opportunities. And all these here you see here are free of charge. Forex is if you were to open a Forex trading account. Okay, so about my promotion. So from now until the end of October, if you were to open a futures trading account, and then you fund in 500 Sing dollars before the 31st of October, right? You'll be receiving, of course, WhatsApp services I mentioned, the email service I mentioned, then regular updates on these indicators I mentioned and many more. I mentioned to you that there are a lot more indicators that I use to first economic-wise, financial analysis-wise, and also market depth. There's a couple more apart from the FANG Plus and the ADL. And then also you'll be receiving this free e-report that I wrote on recommending 20 investing ideas on US stocks with strong mode. Strong mode meaning that they are stocks with strong competitive advantages. On this report, I lay down how I source them out. Basically, they are stocks in the Morningstar Mode Index. So these are stocks that they have created that they have strong competitive advantage. Strong competitive advantage meaning that they are not so easily being overtaken by competitors. And then beyond that, I look at their growth, historical growth, and also look at their valuation. Must be a low valuation now compared to the past. And I also look at their future projections. Right, so these are projections done by various analysts projecting how the growth for their sales and for the profits is going to be over the next 5 years. Right, so I want to only those that I see will have opportunities to double their profits over the next 5 years. They are inside this list of 20 stocks. So if you open an account with me today, even though it's a futures trading account, but you are trading the US stock index futures, so I assume you'll be keen to know about what are some of the US stocks that you can also invest in. So if you open an account, you fund in 500 before 31st October, you'll receive this report from me. So apart from that, if you like to have a coaching session, you can arrange it, whether face-to-face or whether be it online via Zoom. Be sharing with you more about this macro financial analysis. If you are keen to do it yourself, how you can do so, or if you think you don't have the time to go and do all these studies, at the very least, if you understand them, so when I send a WhatsApp message to you telling you that this and that and why is it so, you understand the reason. So when you place your trades, you will have a higher conviction, right? Because you know the reason that is driving the market. You know the reason why the market may go up or the market may come down, right? So and then market strength analysis as well. And there's one thing that I never mentioned just because of the short time is intermarket analysis, right? Intermarket analysis is very interesting because there are markets that influence each other, and sometimes there are markets that move ahead for a certain period of time, may move ahead of the stock index itself, right? For example, prior to this issue that we have with inflation, crude oil is actually a pretty good leading indicator for stock market, right? Lead by probably for a long period of time, by almost I think 8 to 10 weeks. So and the correlation is about 60%, right? So you will not see the same magnitude of move, but the turn, right, is almost pretty consistent, like between when the crude oil start moving up, right, then 8 to 10 weeks later, the stock market may start to go up. And if you think about it, it is logical because crude oil is a blood that drives the whole economy, right? Because businesses need energy, we need energy, right? So when economy is good, right, more energy is used, then they will drive up, right, the demand for the crude oil, and because crude oil is so volatile, is so traded on a daily basis. So therefore, there are traders out there who are more akin to the direction that the market may move, may actually start to trade the crude oil way before the market actually moves. But of course, this year not so good because I think inflation has sort of kicked it out of whack. So we have to wait for it to come back into the normal trading condition again. When that day comes, then perhaps we can start to use crude oil as a good leading indicator for our intermarket analysis. Another indicator for some of my clients, they have received message from me that I look at Bitcoin. I don't trade Bitcoin. Generally, I don't encourage trading Bitcoin as well, but mainly because I don't really understand it. But I do see that it has influence to the stock market, especially the Nasdaq. And I think the reason is because you have the same group of people who likes to trade Bitcoin are the same group of people who likes to trade those high growth stocks, which is what Nasdaq is all about. So so that could be the reason why that, and instead of just selecting the stocks and study about how the stock is doing, right? If you just trade the Bitcoin itself, in a sense, if the direction movement wise they are related, it's so much easier, right? So, but of course, I'm not using this as a trading tool. I'm using it more as a indicator, intermarket analysis. So now I'm also waiting for Bitcoin to move. For the last couple of days, it went up above 20K. Analysis wise, it seems pretty good, but not yet. So maybe I will know the next couple of days, the next couple of weeks, when there's a more definitive signal. Then of course I will be alerting my clients that the Bitcoin is moving in certain direction. So perhaps that may be good news for stock index, right? But of course, one good news for Bitcoin right now is that even though stock index has been going down, Bitcoin has basically stayed stable, right? At 19,000, 20,000 has been hovering there. It's not going up, but it's not going down lower as well. So perhaps all the selling has been exhausted. We don't know. Perhaps selling come later, we don't know. But as of now, this is what we see. So maybe we'll know more in the 2 to 3 weeks time. Right. Then of course, then we move on to technical analysis. Just like I mentioned about the uptrend, downtrend. There's actually some technique you can use to help you to understand, to plot out the lines, uptrend and downtrend. And the reason why this technique is good is because it's not that it is accurate or what, it's just that it is consistent, so that whenever you plot out, you'll not be subject to guessing. Like you guess that it's an up move, you guess that it's an uptrend, you guess that it's a downtrend. So if you have some technique to help you plot it out, even though that you may plot out that it has broken down uptrend, but it turns down again, but at least it is consistent. So it is something that consistency is very important when it comes to trading. So you cannot, like, today you think it's this way, tomorrow you think it's another way. When you are not consistent, then you don't know why you are wrong, right? So also this is just something additional. We have a Forex promotion going on. If you are keen, you can scan the QR code to find out more. You'll be rewarded with some incentives when you trade the Forex. We will open a Forex account on MT5 and trade Forex. Okay, so this is my contact. I'm Eric Lee, Sales Director, Philip Nova. My email, my mobile number, my LinkedIn, and Stock Whisperer SG is basically a website I collaborate with another colleague. So on and off, I'll be posting up some of the trading view or investment view. It could be various topics or various assets into this website. And my LinkedIn also, sometimes I post some of my views on it as well. Yeah, any other questions apart from what I received just now? No, okay, good. Right, hey, thank you for your time. So please take a picture of this page if you want to apply for a demo account, or you want to find out more about upcoming webinar, or even if you want to open an account, you can scan the QR code and follow the process. Right, you have been a good audience. Thanks for giving me the attention. Sorry about the short overrun. I hope that whatever I share is useful to you. And then please look out for the future hybrid seminar. Hopefully, some of you can come up so that we can meet each other face to face and have a chat, more chat about the market. Right. Thank you.